Welcome to the fourth lecture on the series of Predictive Analytics Regression and Classification course. In the first three lectures, we discussed some basic concept of OLS regressions, Gauss-Markov theorem, model assumptions, model checking with R square adjusted R square, root mean square error, AIC, BIC. And then we discussed the multicollinearity issue that you can face. Then we discussed the variable selections, based subset selection, feature selection, backward stepwise selections, and all these issues. And at the end, we discussed some issues on ill-post problems and how penalized likelihood optimization can solve these ill-post problems, and how reach solution and lasso solution can be developed using penalized likelihood optimization technique. Now, in this lecture, we will take a little bit detour and we will see a nice application of regression model in statistical finance or quantitative finance. In statistical finance or quantitative finance, there is a very well celebrated model is there. It's called capital asset pricing model, and this model is a very successful application of linear regression model. So we will see in this part that how simple linear regression model can successfully be applied in solving statistical finance problem or quantitative finance problem. So as we discussed that one of the popular application of regression model is in the statistical or quantitative finance capital asset pricing model, and in short it is known as CAPM or CAPM. The purpose of CAPM is to evaluate if a particular asset, say stock, is overpriced or underpriced or fairly priced. If it is fairly priced, then you know that okay, it is probably the correct price or at the equilibrium. But it is overpriced, then probably you would not like to buy the asset, or you will stay away from the asset. Or if you already holding the asset, if you think that it is overpriced and it may fall, then probably you would like to sell the asset. And if it is underpriced, then definitely you'd like to hold on to the asset, and or you if you don't have the asset, then you would like to buy the asset. For example, suppose price of one share of Reliance Industry is rupees 2100. As an investor, you may have the following questions. Number one, is rupees 2100 too high a price to pay for one share of Reliance Industries? If it is already very overpriced, what is the chance that it will drop very sharply? Another question that on the same note you can ask the reverse question, is 2100 too low? That means it is underpriced. If it is already underpriced, then you would probably expect that the price will go up in future. So this is one kind of question that you may ask yourself. Another question you may ask, what if we invest this rupees 2100 in fixed deposit? So you can either invest this 2100 in a fixed deposit and earn some guaranteed return, or you can invest it in Reliance Industries share price. Now question is which one you would like to do, and we will explore these two major questions in the coming slides or in the next few minutes. As we want to know or figure out whether price of a stock will go up or go down, we need a baseline to compare. Suppose P0, P1, P2 and Pn, these are the prices of a stock over a time period. We would be interested in the change in price over the period from t minus 1 to t. So R sub t is pt minus pt minus 1 divided by pt minus 1 times 100. So RT is known as simple return of stock over period t minus 1 to t, represent the percentage change of stock with respect to pt minus 1. Sometimes it is this return is calculated without 100 also. In that time we will call it as a proportion. So simple return, here I am defining it without 100, but typically it is multiplied by 100 as and present it as a percentage. But for the time being, we just keep it simple, and we are going to when analyze it without 100. Simple return is defined as pt minus pt minus 1 divided by pt minus 1. So RT is the known as simple return over pt over a period t minus 1 and t. Similarly, there is another definition of return. It's known as log return, which is here we are going to denote it as a small r sub t is a log of p sub t by p sub t minus 1. Now, simple return can be expressed as you take the pt, divide the both side of the pt by pt minus 1, and then pt by pt minus 1 you can write it as a to the power rt minus 1. So r sub t is actually your log return. So if you take e to the power rt, then this is pt by pt minus 1. So what it says tells you that simple return can be expressed as a one-to-one function of the log return. Now, if we can download the Reliance Industries data using R, we can use the T series package, and there is a in the T series package there is a function called get.hist.quote, and you can provide the instrument name as the reliance.ns. So it will download the data from of the NSE data. I have given start date for 5 days. About 6 days of data will be pulled from 2020-07-07 to 2020-08-04. So typically the data that comes with open, high, low, close and adjusted close. So adjusted, generally we work with the adjusted close because sometimes what happens that the company announces dividend or bonus shares or this kind of things, and because of that the close price needs to be adjusted for these kind of informations. So that's why it is better to always work with the adjusted close prices. So, and provider is Yahoo. So from Yahoo it will pull the data, and that is how the data came. So as of 3rd August 2020, the price of Reliance Industry is 2009, but 27th of July it was 2156 rupees 20 paisa was the price. That was the adjusted close price, but within a day it can vary reasonably with certain fluctuations can happen. Now you can compute the simple log return and the adjusted and the simple return in the following way. So log return is basically you take the log of the prices. These are the, remember that in the Reliance you have the adjusted close prices. You take the log of this price and they take the differences. If you use the differences, it will take the consecutive differences of the two prices. That will give you the lnrt or the log return, and rt is the simple return which you can compute as a e to the power rt minus 1 using this formula. Okay, and then what I have done, I just presented as a percentage between the same log return and simple return, and you can see that effectively log return and the simple return, they are very close to each other, almost no difference. Maybe after second or third decimal place there are some differences, but effectively in terms of percentage there is almost no difference. And that is one of the reason people when we people work on the daily return, people work with the log return. And though during the when we talk about the presentation of the return and all, people tend to say that it is a simple return, but there is certain other advantages of using log return or work with the log return. Some mathematical advantages are there. Because of the time constraint, I will not talk about it. Next semester, in case I am thinking of offering a course on financial statistics, if I offer that course or whenever in future I will offer the course, I will explain why people prefer to use log return over the simple return when the mathematical analysis are being done. So now onwards, we will only focus on the log return. Now I'm going to explain phenomena called risk premium, a concept. The risk premium is defined as the log return minus RF is the risk-free rate of return. So what is risk-free rate of return? So typically in each country you will have a bank which is sort of owned by the biggest bank or the most safest bank which will not default, and you can put your money in that bank as a deposit, and the bank at the end of the term period will give you certain interest payment on the deposit to you. That will be your earning from your deposit. Now, so if you think that that bank is really very solvent and almost no risk is there, I mean nothing is really riskless, but for the it is typically known as the risk free return. One way of thinking is that suppose a bond or sovereign bond is available in the market. Sometimes government of India or the Reserve Bank of India do issue sovereign bond on behalf of government of India, and those are available in typically in the banks and for the general public. And if you buy these bonds, then basically the interest payments that are coming from these bonds will be, you can feel, consider them as a risk-free rate of return. So I will give you an example of risk premium. Suppose you invest your money in State Bank of India's fixed deposit. I mean, we can for all purpose, all mini purpose, we can expect that State Bank of India will not default in its obligation. So we can say that okay, our investment in State Bank of India and the return from it will be guaranteed and there is no risk at all. Though later we will learn that there is some always some risk, very minute risk, but there is some risk, we cannot completely ignore that. But for the time being, let's consider it's a almost like a sovereign bonds. So SBI suppose gives you an interest of income of 6%. So that means if you have 100 rupees, if you deposit it into the State Bank of India's fixed deposit scheme, State Bank of India will give you 6% income at the end of the year, guaranteed. Now, instead of investing in Bank of India's fixed deposit scheme, suppose you invested in the equity of the Reliance Industries. Fine. Now you don't know whether your investment at the end of the year will go up or go down. It might happen the share price of Reliance industry goes up by 15% over a period of 1 year. If that happens, your risk premium is 15% minus 6%, 9%. This 9% you are earning because you are taking a risk, additional risk over the deposit that you could have done for state if you have parked your money in State Bank of India's fixed deposit scheme. So this is a very interesting concept. So you have to understand that you could have deposit or you could have parked your money in State Bank of India's fixed deposit scheme, and that would have given you 6% rate of income for almost for null risk, no risk. You could have earned 6%. But now you have put your money in with the Reliance Industries equity. You have taken a risk along with Reliance Industries. If the price of Reliance Industry goes up, that additional 9% and goes up to 15% in one single year, that additional 9% is the premium that you are earning for taking extra risk over risk-free rate of return. Suppose the share price of Reliance goes down by 15% over a period of 1 year. Now your risk premium is not actually 15%, actually it is negative 21% because you have lost that 6% interest income that you could have earned if you would have parked your money in the fixed deposit of State Bank of India. So that the negative 21% is the risk premium that you are effectively earning, or in this case you are losing. So you are not only losing 15% of your investment, you are also losing the 6% income that you could have earned during that period. So actual loss is 21%. So you have to keep that in mind. So our all the models now onwards we will develop on risk premium. Now there is a third question that you have to ask yourself: should we invest directly in an equity or exchange traded fund? So what is exchange traded fund, or ETFs? The ETFs are special type of mutual fund. It says that it follows a market index, but effectively if you have 1000 rupees, if you put it into a ETF, then they will take your money and pretty much they will put invest in a as a mutual fund. They will act as a mutual fund and they will put it into a basket of shares or equity, almost on the same equal to the market weight of those equities, so that the portfolio return will follow or mimic the a particular index that this ETF is actually following. So we have to model the risk premium of equity as a function of the risk premium of the market ETF. And it is believed that investing in the market or the exchange traded fund or the mutual fund is safer than the directly on the equity. And why it is so, I will explain in few minutes. So effectively you have three possible instruments where you can invest. One, SBI's fixed deposit scheme, where you are guaranteed to have 6% return at the end of the year. Second, a Nifty 50 exchange traded fund. And a third, is a particular equity, say Reliance or HDFC Bank or State Bank of India's equity, etc., etc. Any kind of a particular company's equity you can invest. So either of the three you can invest. So now question is where to invest and how to invest. In that respect, the capital asset pricing model comes into the picture. So capital asset pricing model can be explained in some sort of in this way. So RT minus RTF equal to alpha plus beta times RTM minus RTF plus epsilon T. So what is RT? RT is the return of asset or equity. As for example, return of say Reliance equity. You can take HDFC Bank or State Bank of India or TCS or Infosys, anything. I have, just for an example, I have taken Reliance. I have no particular fascination for Reliance. I just took Reliance for just an example. RTM is the return of market index. As for example, Nifty 50 exchange traded for an ETF. And RTF is the risk-free rate of return or return of State Bank of India's fixed deposit. We will take it as a 6% for now. Now, CAPM can be explained in the following way. So this is the risk premium, RT minus RTF is the risk premium, which we denote it as RT bar, can be viewed as a premium of taking risk with the equity. Now RT bar M is the RTM minus RTF, which can be viewed as the premium for taking risk with the market. So either you can invest in the ETF or you can invest in the equity. So if you invest in the ETF, then this will be the risk premium. And if you invest in the equity, then this will be the risk premium. Now, equity return can be split into two parts. A given day, equity return is going up or down because the overall market is going up or down. And typically it has happened that, when the market crashed, even a best stock, their return also go down. It has nothing to do with the, that stock's performance or that equity, that company's performance. The company may have posted a fantastic report, but as soon as there is some panic mode comes in, if the entire market is going down, even if we know that this particular company is doing fantastic, the overall in the that company will return will also keep going down. So in a sense that these returns or risk premium can be explained as a function of the market. So this part of the return of the equity return can be explained as a function of market. So we call it as a systematic return or systematic risk. And this part which we cannot explain, this is, a very weird thing. Suppose a question comes in that, okay, the CEO got a, little bit of sick or sneezes in the time of pandemic. If this kind of information comes out that CEO of the company got a sneeze or cough or, breathlessness, then naturally people will panic and they will try to sell the and that company's, price will go down. So this kind of behavior is purely specific to the particular equity. So this kind of, and which we cannot explain as a function of market or anything. So we call this kind of return is due to some idiosyncratic risk which we cannot explain, or unexplainable risk. Now we can express it as expected value of the RT bar equal to alpha plus RTM bar, where expected value of epsilon T equal to 0, variance of epsilon T is sigma square, and covariance of epsilon T and epsilon T dash is 0. So that means mean zero, homoscedastic variance, and randomness is there. There is some, at least the epsilon t and epsilon t dash, they are uncorrelated. Now, in this model, what alpha and beta means, these alphas and betas has a very interesting interpretation. Suppose alpha is 0 and beta is 1.25. It means if market return goes up by 1%, then equity will go up by 1.25%. So if the market return goes up by 1%, then expected market return will go up by 1.25%. On the other hand, if the market return goes down by 1%, then expected, you can expect that that particular equity's return will go down by 1.25%. Now, what happens if the beta is 0.85? It means if the market return goes up by, that means RTM bar, it goes up by 1%, equity will go up by on an average 0.85%. On the other hand, if the market return goes down by 1%, if this goes down by 1%, then on an average the equity will go down by 0.85%. So in a sense, beta is a measure of systematic risk, that how much you can explain that goes up or down just because the market is going up or down. Now let us try to understand what alpha means here. Suppose beta is 1, exactly 1, and alpha is 0.01. It means if market return is 0% on a, still the equity goes up by 0.01%. What does it mean? That means even if market is flat, if the market is flat, then the market return will be very close to 0 or 0, but the equity has gone up. This particular equity has gone up by 0.01%. Why? Because this equity is intrinsically undervalued. More purchase pressure makes the price to go up, because some reason market participant believes that this particular stock is underpriced, so people are buying this stock even if overall market is flat, and because there is a purchase pressure, the price has gone up, that resulted a positive return, and that is why the stock is seeing a positive return of 0.01% or alpha to be 0.01%. So what does it mean? It means if the alpha is greater than 0, we can say the stock is undervalued. If the alpha is less than 0, then we can say stock is overvalued. And if alpha is equal to 0, the stock, we can say the stock is fairly valued. The price is fair price. Now I'm going to make certain assumptions. These assumptions are known as the assumptions of efficient market. What are the assumptions? The first assumption is no insider trading is allowed. That means nobody has any additional information which is not known to the general public among the participants. All publicly available informations are already available to everybody and easily accessible. There is no substantial tax, transaction cost, entry or exit bar. And the fourth assumption is there is no limitation on long or short positions. That means there is no limitations on how much you want to buy or how much you want to sell. These assumptions are some of these assumptions are questionable, but for the time being, let's assume these assumptions are fine. And entire capital asset pricing model was developed under these assumptions. So we will see how the capital how the model behaves under these assumptions, and then we will discuss if some of the assumptions gets violated. So under these assumptions, any non-zero alpha will discover very quickly. So if there is a alpha which is greater than 0 or less than 0, this will be discovered very quickly by all the market participants. If the alpha is greater than 0, then immediately people will start buying that stock, and as a result the alpha will goes to 0. On the other hand, if the alpha is negative, people immediately, very quickly, people will figure out, okay, this particular stock is overpriced, they will start selling it, and this alpha will again goes to 0. Because of the selling pressure, the price will fall, and whatever the alpha negative was there, that will go to 0. So under the efficient market assumption, alpha is always 0, and hence expected value of RT bar is equal to beta times RTM bar. Because alpha is 0, we just replaced it. Now what is RT bar? RT bar is RT minus RTF, and what is RTM bar? RTM, the market return, minus RTF. So I can re rewrite this as expected value of RT equal to RTF plus beta times RTM minus RTF. Now this is the equation that you will see most of the textbook, economics textbooks or quantitative finance textbook, but this is how we can explain the capital asset pricing model. But remember that the outcome of a CAPM under efficient market, what is the outcome? Under the efficient market assumption, it means that nobody will be able to make more return consistently than the market return. The best you can do is your performance will be at best average or similar to that of market return, or some multiples of market return, which is beta. That's it. You can't do more than that. So why invest in individual equity? You should rather invest in either in some mutual fund or market ETF. Now let's look into the efficient market assumptions once more. No insider trading is allowed. Let's assume for the time being, let's it is true, there is no problem with the insider trading. All publicly available informations are already available to everybody and easily accessible. In the days of digital media, digital information, probably to great extent it is also true. There is no substantial tax, transaction cost, entry or exit bar. Now substantial tax assumption, no substantial tax is no assumption. Typically it is a capital gain tax that most of the time you have to pay, is but in most of the developed nations, that as far as I know, there is no major capital gain tax that you have to pay, or even if it is there, it is minimal. So but in India it is bit high than, I would say, compared to the developed nations. Transaction cost is a bit of a asymmetry is there. If you are a big investor, then you can negotiate with your brokerage and make the transaction cost as minimal as possible. But if you're a small investor, then transaction cost could be a bit higher for you. But the assumptions, the efficient market assumes there is no transaction cost, but for in reality in India, the transaction cost could be minimal to substantial. So this assumption really not so grounded in case of India. In case of United States or London, the transaction cost assumption again, for the big player it is almost negligible, but for the small investor it is there. There is an entry and exit bar. In a sense, there is as such no entry and exit bar in the typical equity market, but there are some other markets like commodity market or future market or options market. There could be some margin money that you have to put in to entry or exit. So in the future market there could be some margin money required. That depends on market to market. There is a major assumption called no limitations on long or short positions, but this assumption is really very far from reality. Whether in a under emerging market or in developed nations market, uh, there is always some limitations on the short positions that you can take. Either most of the time it is by the regulatory authority. So you cannot just go ahead and take the short positions. You have to put either buy some margin money or something like that. So yes, so this that means if your alpha is negative and you want to take a short positions, you cannot take unlimited short positions. You can take as much some finite short position. So that means, but if the alpha is positive, you can take as much long position as you want. So as a result, what happens is our reaction to the positive alpha is asymmetric compared to the negative alpha. So as a result, this there is a significant amount of friction in the market, and that alpha is not really zero in real life, and many people believe that alpha is not really zero. It may be very close to zero but not really zero. So deviation from efficient market assumption implies the price is not in the equilibrium anymore. Friction is being introduced. So due to this friction, alpha will become non-zero, but maybe very small. But it is, you cannot just say it is zero. And the model will become something like this. So RTF plus alpha plus beta times RTM minus RTF. So question now, pro- the entire problem boils down to a testing of hypothesis problem. Now, where the null hypothesis is alpha equal to 0, which means the stock is fairly priced and market is efficient, and versus an alternative alpha non-zero, that alpha non-zero means stock is not fairly priced and the market is not efficient. Now, we have reduced the capital asset pricing model into a testing of hypothesis, which is effectively a regression model. And from the regression model, we have come down to a problem of intercept, whether the intercept of the regression model is zero or not, that kind of problems. So I have just given you the R code here. I will just quickly explain. I have taken about 4 months of data from 6th of April 2020 to 6th of August 2020. I have downloaded the Reliance Industries adjusted close price. I have also downloaded the Nifty 50 adjusted close price from the Yahoo, and I have computed the log return of the both prices, and then I plotted here on the x-axis. I plotted the Nifty 50 return. On the y-axis I have plotted the Reliance return, and I have here is the capital asset pricing models, the alpha plus beta times the return, and clearly there is a positive association between between market return and the Reliance return. And you can see there is this line is not passing through zero, so that means alpha is not really zero. alpha is little over the zero, the positive. The alpha is bit positive. And here is the value of alpha. Alpha is 0.0046 and beta is 0.79 or effectively zero point 0.8. Now, if you look into the p-value, p-value is 0.06, so that means at the 5% level of significance we cannot say that Reliance Industries price is undervalued. So there is a, that means there, even if we see that visually there is a, alpha is positive, but we do not, our data is not sufficient to say that, that the market for Reliance Industry stock prices are still fairly priced, and we cannot reject that null hypothesis. And alternate is basically it's a fairly price. We cannot really reject that and say that alpha is non-zero, even if we see there is a bit of a positive alpha. Now note that the this particular test is conducted under the assumption that the epsilon or the idiosyncratic risk or idiosyncratic return follow normal 0 sigma square in. Let's check this out whether these assumptions are correct. So first thing I did, I plotted the residual versus the predicted return, and we don't see any kind of pattern. So perhaps the assumption of linearity is okay. So this assumption is okay perhaps. Now, second, I ran the Bartle's rank test for testing the randomness, and the p-value we found 0.5074. So looks like the assumption of randomness is also okay. So that means covariance of epsilon t and epsilon t dash equal to 0. This assumption is also okay. Then I ran the Bruce-Pagan test against heteroskedasticity. So the alternate is heteroskedasticity and the null is homoskedasticity. And here also Bruce-Pagan test fails to reject the homoskedasticity. So the assumption of homoskedasticity is also okay, looks like. Then I did a QQ plot to check the normality. So what we are seeing that definitely these values are far from the QQ line, and these two values are also far from the QQ line. This is something we have to be a bit careful. And so I have done the Kolmogorov-Spironov test to check normality, and clearly p-value is very small. We say that okay, the assumptions of normality is perhaps not correct. So what do we do? In the next video, we will discuss how can we use non-parametric bootstrap regression to salvage the situation of non-Gaussian distribution in the residual plot, in the residual of the capital asset pricing model. We will discuss about it. One thing I would like to tell you that even if the actual underlying distribution is not Gaussian, perhaps since we have enough data, almost 80 data points are there, perhaps one can try to argue that okay, we have enough data to that so that the central limit theorem will kick in, but still that it is important that the underlying assumptions of the model should be supported by the data. But here a major assumption that the residual distributions follow normal distribution or residuals follow normal distribution, that underlying assumption is completely wrong. So we have to salvage that situation, and one way of solving that problem is using non-parametric bootstrap regression. Thank you so much for watching this video. See you in the next video. Thank you.